Good evening, everybody. This is Chris Gessel. I'm the executive editor of Investors Business Daily, and next to me is Bill O'Neill, the founder of Investors Business Daily. Tonight we're going to be talking about the market as well as the relationship between follow-through days and leaders, that very important relationship there. And then we're going to discuss some current leaders and some emerging names as well. Now, the demand and interest for this webinar has been overwhelming. We have almost 12,000 people who registered. That makes it the biggest finance webinar ever, and we're very pleased that everyone is joining us tonight. With that, let's begin. And actually, we're going to start on something, let's call it the really, really big picture. And we wanted to look at where we are in the overall cycle and what that means about where we might be going. And I'll pass this to Bill at this point.
Thank you, Chris. As you can see, we're looking at starting at 1900 up to right now. And there are some very long cycles of going sideways, maybe 18 or 20 years, and then having a similar period running up that is pretty dramatic. And it's changed a little over the years. From 1950 to 1970, we had a 400% advance, several different bull markets. Then we went through 11 years sideways, back and forth. There was a lot of money made in that time period, but the averages were going back and forth. And then it came out in the early 80s, and it ran up for 18 years by 1,355%. Now, starting with March of 2000, we've gone through a tougher period, usually where the country has made some mistakes. The mistakes started in this situation in 1995 when the government pressured banks to make a lot of loans at lower and lower rates, and we had something that lasted for about 10 or 12 years of just trying to make more loans, and of course that was the financial crisis, and we've been back and forth now for about 12 years. We're in the 13th year. So the reason we're showing you this tonight is because you can hold mankind down just so long and then it comes out of it. We think that a maximum, sometime over the next 6, 12, or 18 months, you're going to start a whole new cycle. You'll have possibly a new administration, new people in Washington, but we're going to come out of this into another series of 3, 4, 5 regular bull markets, which normally last, about 3 3/4 years. Then they go through a 9-month recession, then they come out and go up for another time period. Now, the reason we're starting with this is because our studies go all the way back into the 1800s, and we have found in 27 cycles that every single cycle is led by a new invention or new innovators that have some unique concept, and they almost start whole new industries. So we're going to show you as we go through here how coming out of an intermediate term correction or a bear market correction, most of the bases are formed during those periods, and particularly when you come out of a bearish period, you have the biggest names coming out real fast, and either you're there at the time on top of it and know exactly what you're looking for, or you don't. You just don't handle it right, because at a time when just think about this, at a time that you've gone through a correction in the market, in a bear market, whether it's 9 months or 18 months or some of the longer ones we've seen more recently, you're pretty disappointed, and the news is pretty bad, and you've had some losses, and you're licking the wounds, so to speak. And you don't always believe it when it happens, and the key here, we're going to show you in a little bit, is that the biggest leaders come out right smack on the follow-through day, or a day later, or 2 or 3 days later, at a maximum within a 3-week period. And either you're there and know what you're looking at in a chart and understand how to read chart patterns, or you missed it. And if they run up a little bit, then you're saying, well, that's up too much. And some of these stocks have gone up 20 times, 50 times, and 100 times that we're going to talk about. So this should be a very exciting thing for you, because we're not talking about just day-to-day things. We're talking about how do you make the big money when it is there to be made. And how many different kinds of rules have you got to learn in order to know what you're doing and to really capitalize on what I would say are the enormous opportunities in this country, and yet 90% of investors never capitalize on them. I could ask how many people bought some of the big things like Home Depot when they went up 100%, or then they went up 100 times. So there are many stocks like that that have happened in every cycle, and sometimes they last for 2 cycles, but usually they're replaced by somebody coming along that's cheaper, faster, better, and it keeps coming up with new names, and you've got to recognize the new names as soon as they show up. So let's go to the next thing. We're going to talk about a more recent follow-through that occurred on December 20th, 2011. Actually, I've seen sometimes that on a market average, whether it's the S&P or NASDAQ, when you form a cup with a handle on the index itself, that's telling you something, and every time I've seen that, the market goes up. And this is what you had in late December. If you look at it carefully, the left-hand part of the cup goes down, and your first rally day comes off the bottom. You move up a little bit, and then you pull back into a handle area, and we get a follow-through day, which occurred on the 17th day. Some people may feel that because the follow-through day comes like that a little bit later, it's not going to be as good. But we have a lot of follow-through days that have occurred on a 20th or 25th day. I think that all you want to see is you do follow through and you start a new uptrend. So you can see that this lasted quite a ways. One of the things that happens, sadly, is at that point you've been kicked around and maybe there's 1 or 2 false follow-throughs, and so you don't act, or you're not sure, or the news is so bad you're waiting to see and make sure that it's right, and by the time you make up your mind, you've missed a lot of the real stocks that come out, and we're going to show you some of those in a few minutes. You know how the follow-through days work. We don't normally want to buy something on a first or second day, but starting a third or fourth day, we watch very carefully to see if the market can come on for a second time, and we call that a follow-through, and we want the volume to be up, and we have a certain percentage increase that we want to see on the index. And we always like to buy something on a follow-through day. Even if it doesn't work, you'll usually have time to back out of it a week or 2 or 3 weeks later without any harm. But if you don't buy on that and you're sitting there not believing it, you're running a risk that you're missing the big opportunity and the stocks that are breaking out right in and around that time. So let's go up to the top and we'll show you how we measure when a market is beginning to top out. And we'll turn this over to Chris. You're going to be looking at around the April period where we started having up to 6 distribution days, and he'll go through when we say, okay, you're now into a declining market.
The market beginning, the upturn beginning on December 20th was a little rocky to begin with, and then it really started trending higher, and it was one of the more unusually steady uptrends, and a lot of opportunities existed at that point. And we were getting a distribution day maybe once a week, once every 2 weeks, very little institutional selling on that way up. Now, that started to change as we got into late March and April. And you see that first red arrow there on the left side of the chart. That was a stalling day. The market was up just slightly. Volume was higher than the day before. And the concept behind stalling is pretty simple. The market is moving higher day after day, and then it runs into resistance. And you see a big increase in volume, and the market can't make any more headway. Now, some of the rules around that are kind of complex, but the idea is simple, and we point it out for you in the big picture every day. So that was a key day that was starting to show maybe the market was running into some resistance. There was also another day back in late February. So at that point, we've got 2 distribution days on the count. And we go up, make a new high, and the market reverses, but in lower volume. And then the next day, the market sells off again in higher volume. And so we're 1 day off the top at that point, with 3 distribution days on the NASDAQ, and I think there were maybe 4 or 5 on the S&P at that time. And we were also seeing some stocks coming under pressure as well. And so we put the rally under pressure. And at that point, it's a sign to turn a little defensive. If you've got some losses, you want to cut those losses and start raising some cash. You don't go completely to cash necessarily. You definitely don't want to sell maybe your biggest stocks that you think might be making a big move for the long haul, but you just do want to turn defensive at that period. And then over the next week, we get a couple more distribution days, and by, I think it was, May 4th? There were now 5 distribution days on the NASDAQ. 4 of them had occurred in just 6 days. That's a thing that we've seen over and over, that when you get flurries of distribution in a very short time period, that's a negative sign for the market. And given what we were seeing in the NASDAQ, I think the S&P had 6 days of distribution. We put the market into correction at that point. And again, you want to be defensive. You don't necessarily go completely to cash, but you want to cut those losers. If you've got some 20% gainers, go ahead and take those. And then you hunker down with maybe your best stock or two and see if you're ready to sit through a correction with a stock like that. So we were feeling pretty good about ourselves, but the market has a way of humbling you, doesn't it, Bill?
Yes, it always does.
Yeah. Day to day it is. But at least at the beginning, it looked like we had nailed it right, but then the market started to rally again. On the S&P 500, we had a follow-through on the 11th day of a rally attempt, and it was up 1.4%, which historically is kind of on the low side. But we keep a lot of records and check through the data, and we've got 7 instances going back to 2000 where we've had follow-throughs as low as 1.25% to 1.4% that have worked. Maybe not a raging bull market, but at least a tradable rally. And so over the years, it's become clear it's a lot worse to miss a follow-through than to have a failed follow-through. Missing a follow-through, you miss all the big leaders, and you're really behind the 8 ball. A failed follow-through, well, you might buy a stock or two, and you start scaling in. The market doesn't work. You cut your losses short and move back to the sidelines. We don't want to miss any follow-throughs that might work, and that's one reason why we're eager to at least call follow-throughs even on some of these marginal days. In this case, the market went up for a few days, and we started getting distribution again, and I guess within about a week or so, the uptrend was back under pressure. The NASDAQ gapped down the next day, and we were in a correction and selling off pretty hard until the market came down to below the 200-day moving average. So, Bill, at that point, what are you looking for when you see the market like that?
Well, as you're in a declining phase, you can measure each attempted rally, and you're trying to find out can a rally follow through or not. And we don't do any buying or reach any conclusions on the first or second day, and usually not normally on the third day. However, we have had some instances where if each one of the 3 days are up on good volume and big closes, that we would call a follow-through on the third day. By looking a little bit in hindsight, I think it's possible, and we're going to do some studying on this, that you actually had a follow-through day on that third day up off of the absolute bottom. And if you look at the decline, you had sometimes these declines go in 3 waves. You had one wave down from on the NASDAQ 3,100 to 29, you rally up. Then you had a second wave down to 2,700, you rally up. And then you take the third wave down going below the 200-day line. And the psychology is always there. Market moves to disappoint the majority. So on the first correction, most people don't see it because the distribution takes on the way up. Most people aren't looking at charts, and most people don't even know how to implement the rules we're talking about. But by the second time, maybe somebody sells a few things. But by the third time, they start throwing in the towel and saying, I can't take it any longer, and there's a dumping of stocks. And in other words, it's too late, it's too obvious, and people start selling short. So you'll see the New York Stock Exchange or the put-call ratio or some of these things start to change, and all of a sudden the institutions step in there and they're buying stocks. And I think that you possibly had the real follow-through on the third day. But let's go how we actually call this, because the thing that fooled us a little bit is the volume was not up substantially, but I noticed that it did close on the averages up near the peak each one of the first 3 days, and that's the thing that's making me think that that was probably a signal, and we have to adjust our 3-day rule a little bit. But we had a follow through on the 10th day. The NASDAQ followed through, volume picked up, and at that point, you're looking for something to buy. Now, I can't emphasize enough, we're going to go through this several times with some different examples. There will be a stock that comes out of there right then that could be a big leader, and we're going to go over some of those names in just a minute. But you've got to get to where you're in gear, and the worst thing you can do is you go through this correction and you're kicked around and you say, well, that's it, I throw in the towel and I'm going to quit, or I'm going to cancel my subscription, this market's just no good, and you're making a serious mistake because you've got to be there fully armed and equipped with what you're looking for. You've got to be looking at your charts every week, because out of nowhere, all of a sudden, a follow-through day comes, and I do know some professionals that have seen them come, and they hesitate because they just don't believe it. And that's what should be happening at the bottom. Most people won't believe it. They'll wait until it moves up quite a bit before they begin to get some reassurance. So here we had a follow-through day, and then you got into the whipsaw business.
We're getting some questions on what exactly is a distribution day, and that's a great question. Distribution is when you see the market fall, usually more than 0.2%, but usually it's a lot, you know, 0.5% or 1%. But the market falls in higher volume than the day before. And what that is telling you is that on net, institutions are selling stock. Institutions drive the market up and they drive it down. And when they start selling and you get a flurry of distribution days near a top, that is a negative sign, and we respect that and get out of the way of those institutions. So distribution is selling on the way down.
Chris, let me make one little remark here. The way we track distribution days is it's on a moving, rotating 5-week period. So if in any one 5-week period, which in a normal thing might be 25 days, if we have 6 distribution days, we say that, based on all of our analysis, is so large that that market's going to roll over and go down. And most people don't see this because the first 2 or 3 days usually occur when you're advancing and everybody's happy as a lark. They've got their stocks all up and they're thinking everything is great, and meanwhile you're halfway into getting to the point to where that market's going to top. So I don't pay attention to the first day, second day, or third day. But when I get a 4th day, I start really watching carefully, and I watch my stocks, I'm watching the market, because I know you're getting closer here, and sometimes you drop off a day, because if you go 5 weeks and all you've got is 4 days, and you go into a 6th week, you may drop off a follow-through day. So you have to keep track of this and know at every point, how many days am I right now? Because if you've got 4 or 5 days, you had better really be careful, and you better be selling something and backing away. If you wait until the 6th day, you're a little bit late. Now, if you don't even follow this and don't understand what we're talking about, well, you're sitting there and you're going to get clobbered, because we don't know how low it will go, but we know it's going to go down when the volume of selling in any short 5-week period gets excessive. And this has worked for years for us now. I wanted to throw in that point about the moving 5 weeks so that we're in phase with what's happening in the very recent past.
Is that an automatic thing for you? You get 4 distribution days, you're going to sell at least one stock, or you're going to take a hard look at what you've got?
Ironically, a number of years ago, it only took 3 days. And then as the markets got bigger and bigger, it took 4 days, and then 5, and then we're up to 6. I think at some point it may be 7. But when I get to 5 days, I know that this may last for 2 or 3 days, and then I get a 6th day, and on the 6th day, usually you're breaking down and everything's splitting wide open. So I know I've got to start looking, what do I sell, what do I cut back, and I can't be sitting there fully invested or heavy on margin when a 6th day occurs. And some people even will be buying stock after a 6th day, and that's really asking for it, because 2 days later you're going to get hit real hard.
So after the follow-through that we had on the NASDAQ, that 1.3% follow-through, the market went up, and then 3 days later it reversed hard. had just gotten over the 50-day moving average. And we pay a lot of attention to those early distribution days after a follow-through. What we find is that in the first 5 days, if you get a distribution day, that can be very dangerous, and you need to be careful in a position like that. Sometimes it shakes it off, the market will, and continue higher. But in this case, that's why with just that one distribution day, 3 days after the follow-through, we were already feeling nervous, and it was a huge reversal, not a good day on the market at all, and any stocks that were trying to break out were getting knocked right back. And so 2 days later, another big sell-off, and we were back in a correction. Now, we've gone through these periods of very choppy markets, and while it would be nice if the market would only trend up or only trend down, that's, simply sometimes not how it works. And some people are asking, do you recall any other markets where we've had this choppy action? I mean, this happened in the 70s all the time.
Well, I think anytime you're in a fourth year of recovery, you're going to have a whipsaw back and forth thing that's tough and difficult. We're in a later stage of the overall cycle. So, yeah, it's a little bit unusual, but no, it happens a lot.
So after we went into a correction, the market gapped up, and it was a follow-through on the S&P 500. And let me just define follow-throughs. I know we've been saying that a lot lately, and if some of you don't know that term, a follow-through day usually occurs after the fourth day of an attempted rally, and what you look for is a big gain in heavier volume than the day before, and it's a signal that the trend is changing, that institutional investors are moving back into the market, and that's the time to at least be making some test buys and looking for stocks to buy.
I might mention that 90% of bases are formed because of a correction, whether it's a short-term or intermediate term or bear market or what. So you don't want to get discouraged just because you're going through a correction, because you're building the bases that are going to be the new leaders 3 weeks down the line or a month and a half down the line, whatever. And if you get a little discouraged, you're sitting there not paying attention, or you've been on a vacation and you miss all the new things that suddenly have completed their 12-week base or whatever.
So in just the last few days, the uptrend that we've enjoyed for just a few days, we got a distribution day on Friday. The market sold off a little bit on Monday, and then on Tuesday we had a big, nasty reversal. And again, when we see those distribution days so quickly and coming in groups, that makes us very nervous, plus the fact that a lot of breakouts are not working. They were running up and they're getting knocked back down to their buy points and under their buy points, and so that's why we put the market trend back under pressure, and we'll just take it as it comes at this point. So I think overall we are seeing some areas of resistance, and we're going to have to get through there. What do you see, Bill?
Well, we drew some lines on the charts, and there is heavy overhead supply as you move up, and it looks like you've probably stalled in the last one that's getting up close to the 3,000 area. This is one reason why you have to be very skillful at not only interpreting chart bases, but interpreting the action in the market averages, because most of the stock's going to follow the market averages. So you better understand that it's running into real supply, or it's stalling, or it's beginning to roll over, and you have to act on those things. So we try to do most of our actions based on rules and measurements, not how do we feel based on the news, and that can fool you a lot of times, or somebody else's opinion thinking, well, I think the market's going to go up. Opinions aren't worth much, but markets are almost always right. You just have to learn to interpret them.
Right. And so in an area like this, I know it can get discouraging, and you were saying how many opportunities you can miss if you're not paying attention. A good example is what we saw back in September 2010 when the market followed through.
Well, let's look at that chart. Coming off the bottom, you had a follow-through day on a fourth day of the attempted rally. The volume was up, closed right at the peak. You gapped up on that day. And what I've learned over many, many years is I want to buy something on that day. So late in that day, when I can see this is going to very likely be a follow-through because it's up in a powerful amount, I'm going to find something to buy, and I'm looking for them. Now, on this chart, and sometimes you'll get one big leader that will jump out one day before the follow-through. On this chart, you see Riverbed came out a few days early. TIBX was one day before the follow-through. But guess what? On the follow-through day, Chipotle's comes out, CMG. Now, it had a nice base, exactly the way it should be, and it only went up 186% from that specific day. Now, this is the point I'm trying to drive home. You've got to stay with the market week by week by week. You've got to have a chart service. You've got to understand how to interpret it. If you don't want to do that, you need to get some help with it. That's one of the things they've tried to do with the leaderboard product. If you don't have the time and you don't want to do it, somebody's got to do it, and you better pay attention to it. Well, we've studied all of these follow-through days going back for cycle after cycle after cycle, and the biggest ones come out right there. So here it is, Chipotle's right on that day, breaking out, and it's only going to go up 186%. Now, PetSmart comes out, 2 days later? And that just went up 100%. Then HLF comes out 2 days later. That was up 154%. Then SINA comes out, and that was only up 220%. Now, realize that we're only 1, 2, 3, 4, 5, 6, 7, 8 days. We're in the 8th day of a follow-through, and you're having some of these stocks coming out and going up 100, 200%. Let's see what else we have there. Baidu comes out a little bit later, but it's not quite up as much. It's only up 90%. Lulu comes out, and Lulu, that's only up 274%. But you're sitting there looking at the news, and the news is so terrible because the market was sloppy for the prior 3 months, and you made no money, and you lost money, and you gave up, and you threw in your towel and canceled my chart subscription, and here you are blowing it again. So what I'm trying to get across is that you've got to have rules for when is a market making a bottom and you're having a follow-through day. When are you topping in a market? You've got to have buy rules plus sell rules on the general market. And then you've got to know how to read charts so that you will recognize there is a perfect base on Chipotle's. If you don't believe in charts or you haven't used it or you feel uncomfortable with it, anybody can learn how to do it. There are 9 basic chart patterns, and they're repeated cycle after cycle after cycle. There's nothing new in the market. They're made by the institutional buying, accumulating a stock over 8 or 10 or 12-week period. Sometimes it's 6 months, but you've got to learn to recognize that pattern. And we've come up with many stocks just by recognizing the pattern in and around these market bottoms. Now, there's another step to that. We're not going to go into it right now, but we will in a little bit. After you recognize the pattern, now you go and find out what do they do, what do they make. You read a story on it. You run a checklist out on the website. How much are their earnings up? Well, you find out this company has earnings up 30, 40% quarter after quarter after quarter, and they've got a huge return on equity, and all the other measurements that are fundamental are critical. You want the combination of a perfect chart, the market has turned, and they've got big earnings, and they're a leader in their particular industry. So you put all those little pieces together, and what this means to you is you got to get serious about the market. You can't just work at it some and think you're going to get it down. You've got to learn how to read charts. You've got to learn how to make sure you've got the best fundamentals, how to really evaluate a stock properly. Forget the P/E ratio. That is not a sound way to select stocks. We know some of the top money managers in the country that have been at it for years, and they understand this. They don't care whether it's 20 times or 50 times. They assume the market knows what it's doing. What they want to know is this company got a leading product that's gaining share of market, and they have a big return on equity and big sales and big earnings, and they're not going to argue with the marketplace. So you'll find sometimes that it may be a low PE, it may be a mid PE or a high PE. If you happen to have the opinion that that's one of the key ways you select stocks, you aren't going to perform with the very biggest and best of them. Now, I've gone through some of the moves that show up right at this critical point. Our studies go over 27 cycles all the way back to 1880, and the biggest leaders come out in the first 3 weeks, coming right off the bottom when everybody is unsure, they're afraid, and they're licking their wounds. So we're showing you how the market in reality actually works, not how most people think it works or how they would like for it to work or what they believe in. So you can't go by opinions. You got to go by facts and the market. And we think that charts are absolutely essential if you want to recognize patterns. If you don't believe in that, well, tell your doctor that you don't believe in getting an MRI or some of these other things that they want to see to understand what's actually going on in your body.
This pattern of the market bottoming, following through, and then all the leaders breaking out shows up over and over, and it happened just a few months ago in December.
Well, let's see. You're talking about December 20th, I guess.
Yep.
Well, that was in 2011. Now, here you had that little cup with a handle again we're talking about. Now, we only had a short duration of time coming out of this one, but we did have BWLD, what up, 44%. Let's see. Oh, they were right on that day. That's interesting. This is time to ask a question. Did you buy stock on that day? Just think about it for a bit. Write down that date and go back in your figures and find out, did you buy stock on that day or not? How about 2 days later? 3 days later? Did you buy stock? 4 days later? We got 5 or 6 days. Here we have ISRG. Let's see, what did that do? Oh, 32%. Now, remember, this is only in a couple of months that we're showing this. So the one we looked at before where you had 100, 200%, that's because we had a year to look at it, or a year and a half. Celgene, CLR, what's that? You see CLR and you say, well, what is that? Well, go read a story, find out what do they do, what do they make. So most of these had moves between about 20, 30, 40, 50, 60%. Coors, K-O-R-S, went up 84%. Apple went up 51%. So the point here is the biggest and best leaders come out after you have a follow-through day, and the best ones come out in the first 2 or 3 weeks, and that's been going on for 27 market cycles. Now, there's one other point to make here. You might say, well, yeah, but it may not happen in the future. Yes, it will happen in the future. In other words, you come out of this 12-year back-and-forth adjustment phase that we're going through, adjusting for the incompetence that our government had in forcing us into a problem in the mortgage market and a financial crisis. Incidentally, they don't admit to that. They try to blame the banks. They're the ones that forced the banks to do this. But in the 1970s, you went through a period where we had rampant inflation. 21% interest rates, lines at the gas station, all sorts of problems that the government was having, and we finally came out of it. But you're going to see a whole raft of new innovators and entrepreneurs come out in the next series of bull markets. Now, why can we say that? Well, it's very simple. The innovators and entrepreneurs are busy doing their thing, and they don't care who's in Washington or how Washington is helping or hurting. They're out there inventing their new gizmo. There's a new Apple out there. There's a new Google out there. And you'll see them, and you'll recognize them if you understand how to recognize chart bases, and if you know and understand the psychology of buying when you get follow-through days at a point where nobody believes it, yet you've built a whole series of new bases, and each one will come out with a different set of leaders. They're the leaders at that time and point that are accelerating their earnings and sales the most. So you got to learn how to operate with this system, and we've done very well over the years using this system.
Bill, why don't we take a look at how these charts appear? So let's take a look at Priceline. That was one of the stocks that broke out in January after the follow-through. And give me your thoughts on those couple chart patterns.
Let's go back to this September 10 period where you have a market correction, and you have your follow-through day. And on the follow-through day, right after that, Priceline breaks out, and it runs up a dramatic amount on huge volume for the week. Now, I got to tell you, we have a sister company that's an institutional brokerage firm, and we put the stock on our buy list right there at that time. So when we're talking to you about some of these things, we have been able to do that sort of situation over and over again because we operate with a set of rules and a set of patterns based on past history. We're not interested in inside information. We're interested in history that repeats itself with a constant flow of innovators in America because of all the freedom and opportunity there is. Anybody can do anything they want. So there's always somebody coming out of somewhere, and they may be in Seattle, like what was that company that went up 100 times?
Starbucks?
Well, that.
Oh, Microsoft, yeah.
Oh, Microsoft.
Too.
Oh, gee. And that came out as a new issue, and as soon as the market turned, it took off and ran like crazy. It only went up 100 times. So this market correction came out, and you came out of a large cup without a handle. It went straight up, and it kept running from that. And then you went to the next correction, and you base built and base built. And these bases sometimes, after a long, long run, you'll have a first time they try to go out, and it piddles around and comes back, and the second time it fails. But then about a third time, it starts to tighten up, and in that period in March, you built a little cup with a handle, and it breaks out right over the 500 price area and has its run up into the 700 price zone. And we put that stock on our list exactly on that same week at that point. If you go through the chart patterns, let's look at the last base that's coming out in March of 2012. The first 2 days down, weeks. You have to look at the volume figures. The second week down, the stock breaks below its 10-week moving average line, the little red wavy line that's going through the base, and we're talking about in the December 11 quarter. You don't sell the stock when it breaks below a 10-week line and the volume is low. You only sell it if the first time it breaks and the volume is huge and it closes the week, not that it goes below the line sometime during the week. You have to wait and see where it closes for the week. So then you had a second time when you're coming down below the line. The second or third time, it's a little different because the first time is key. If the volume is huge, you would be selling it. But if it comes with the volume picking up, second, third, or fourth time, it's not necessarily the same, and you want to see how it closes for the week. If it closes in the at least 40% off that low, you're getting support there. And then you dry up and you go tight for 3 or 4 weeks, which is a sign of accumulation. You rally up for 1, 2, 3, 4, 5 weeks in a row, and we find on our charts that you have 5 weeks in a row up. That's a very positive sign of accumulation. And if you look carefully, several of those weeks are closing at a peak. You go sideways a little bit, and you break out and start running up. So there's your chart pattern recognition as the market is coming through a falling through day a few weeks before. So Chris talked about to begin with, it's interrelated. You've got to watch the market, and when it comes out of a correction, the bases that are sound are formed, and you've got to recognize, is this a sound base or not, and are the big earnings there? And, of course, the big earnings are there with Priceline, and so that's why we would put it on. So there are specific things you're looking for, and it's not 1 or 2 or 3 things. It's a long list of items.
Chart reading takes some time and effort. And one way that we've shortened the learning curve is we've introduced Leaderboard. And in Leaderboard, you'll see here's Priceline. We actually had this on Leaderboard before it broke out in early February. And we note the base, the positives and negatives. We also notate the daily charts. And you'll see right around the buy point was 549.10, and we mark the buy points in blue and show you how far it's good to buy, 5% past that buy area, and the stock starts moving up. And then more than 3 weeks later, it's up 20%. And so we're noting here that this is a place where you could take your 20% profit, or you could let it go. When it broke through the 10-day moving average, after it made that 20% gain, we noted that as well. And so we're giving you buy and sell areas, finding the bases for you, and just kind of helping you along the way. So the whole idea about Leaderboard is think of it as real-time education, and we're helping you learn and apply the rules of investing every day. In fact, actually quite a few stocks that Bill was talking about coming out of the December 20th follow-through day were on leaderboard. Overall, we had an 83% win rate. On average, each of these stocks doubled the gain of the S&P 500, and a good chunk of them were up to 20% and over 20%. I think the important thing to take away from a slide like this is that even in, what was it, Bill, like a 3.5, maybe a 4-month rally that was, fairly abbreviated, but if you were following the rules, engaged in taking advantage of these gains, there were a lot of good profits to be made in the first quarter.
Yes, and I think we've got to be realistic and tell everybody that the market isn't easy. You have a lot of things in life that are easy. You can go in the grocery store and buy something to stick in the oven for a minute and almost have your dinner. But the market is very complicated. I think it's somewhat like being a fighter pilot flying jets. You have to be really skillful and learn a lot and have real discipline. I think it's a little bit like in athletics, and I think it's a little bit like medical school. Not many people go to medical school and learn all those things. I've talked to a lot of doctors, and some of them that are interested in the market, they say, hey, you guys are teaching the same way we were taught in medical school, that you have rules about what do you do. And I asked a surgeon how many different items did he have to look at before he would make a decision. And he thought about it for a minute, and he said, well, there's 6 different things I have to do. I got to get a blood test. I got to get a picture. I got to this. And he goes down the line, and they will tell me that they know what to do if something happens because they're trained and they're professionals. And I think you've got to look at the market just like this. You've got to get trained. You've got to get serious. You've got to decide that there are things that you need to learn how to do. And if you do that, you're going to capitalize on these great companies that come out every cycle. And I can show you in a model book that American Online came out and one of these, and Apple came out, and it goes on and on and on, and Cisco System, and there are so many unbelievable ones, but what you need to do is find out how to recognize them, and then the big thing is have enough rules so that when you get in the middle of the battlefield, you don't get shaken out and you know how to handle it until it violates a major rule. A major rule, I would say, is that if it goes into a climax run, and we've defined them very precisely in my book, How to Make Money in Stocks. If you go through an upside channel line, we've defined exactly how you plot a channel line. And also, if a stock is extended a substantial amount and it's gone through several bases, and you're in a 3rd or 4th stage one, or you're having maybe 1 or 2 weeks down to the 10-week line and you come back 1 or 2 weeks up, straight down and straight up, if that goes into new high ground, I'd sell the stock because that's not a base and it's very extended. So we have a whole ton of sell rules, when to sell on the way up and take a profit. And I think a lot of people invest and they don't have any idea when they're going to sell it. They just think they got a good company, and so what happens? Well, all of a sudden it starts having problems, and it's like a tennis player that says, well, I can hit a forehand pretty good, but I don't know about this backhand business. How do you handle a backhand? So I think you got to get serious, and charting is a part of it. I think it's an essential. And then the fundamentals must be put together with it, and you do that, and you learn how to have rules dictate what you're going to do rather than how you feel or what your personal opinion is. I find that men, sometimes the brighter they are, the more mistakes they make because they think that their opinion is what's important, and it's not. It's a skill to recognize what's actually going on and to read the market correctly and sort through that 1% that you're really looking for.
Well, what you say about rules is absolutely true, and if we look at the daily chart of InventSense, you'll see the rules on parade here. Now, InventSense was a new stock. I'd never heard of it before, but it hit our screens, and those are based on rules of what stocks look like before they break out. So we saw the stock. We identified the buy point. It ran up more than 20% in less than 3 weeks. That's a rule that you got to hold it for 8 weeks. And, in fact, in this case, you see right after we put that 20% flag on there, the stock really sold off hard for 2 days. And without a rule, most people would be selling it. It was very difficult to sit through that stock at that point, but we knew that we had the 8-week rule, and we needed to hold it those 8 weeks. The stock continued up. It pulled back to the 10-week line, the 50-day on this chart, a place to add shares, and then it went up over 20. It doubled in a short amount of time, but it was getting really sloppy and volatile, and when it broke through the 10-week in very heavy volume, you see that red flag there, we were taking that as a sell signal, and we moved it to the cut list. And again, there's a lot of rules in investing. With Leaderboard, we help shorten the learning curve. It's like real-time learning, and we help you apply these rules every day. So we're going to look at some leadership stocks, but before we do that, I just want to take a little bit of a break and thank everyone for joining us tonight. And we've put out some special offers, special pricing on the print, the the digital edition, as well as Leaderboard, and you'll see the URLs for each of these. And in addition to the special pricing, you'll get a free level 1 and a DVD that shows you how to put IBD to work immediately, and it includes a routine for you to start following. So if you want to take advantage of this, please do. The other thing, for current subscribers, go to these URLs and you can add a year of whatever you like to your subscription for the print or the at the same price. And you'll get the level 1 if you like it as well.
Should we open up some questions pretty soon?
Let's just take a look at, before we go to general questions, let's just take a quick look at maybe a stock that's setting up. One would be Apple. You want to look at that chart?
Well, that's very debatable right now because I think it's going to be a function of the general market and what the market's going to do. But obviously this is one of the most outstanding companies out there, and most funds that are on top of it have a big position in it. And the earnings are there, the product's there, every single thing is there, but it will be a function of the market. What you've had develop is a base more recently, and it is a little cup with a handle, and it's been coming out of there in around the 600 area, but it's a function of the market, I think, at this point. But we've had it coming out of base after base over a period of time.
I think Apple is very unusual in that it's 1 in 1,000 or 1 in 10,000 companies that can make base after base and keep breaking up, because typically you don't get such a long run without a major correction.
Well, let me make a point here. We came up with Apple in our institutional firm at $12 on a split-adjusted basis, and I guess that was back in 2004 or 3, whatever it was.
2004.
$12 on a split-adjusted basis. And when we came up with it, we weren't even sure whether we should put it on our list because its record had been so pathetic in the prior 2 years. It was not very good. But the pattern was a perfect cup with a handle, and it was under accumulation, and the last 2 quarters were up 100% or so, and it fit all our parameters, and we put it on the list just based on the fact that we look at charts, maybe 500 or so, every week, and we saw that, and we said, there's one right there, and we looked at it, and we couldn't believe it because the prior record was so poor. We didn't understand what was really going on in the company at that point, so it breaks out and runs up and goes sideways for a while, and then it goes up a little bit more and sideways. Then it builds a base on base on base in a tight area, and then it makes another absolutely perfect base with huge volume right in the middle of the base that is a major tip-off. And most of the money that we made in that stock came from that particular base, and it doubled and tripled and quadrupled, and it went through corrections, and it would come out of it and double again. This is what it's all about. In other words, your job isn't to be right in the market, but it's to make bigger money when you're right. And in order to do that, you got to have charts. So if any of you don't have a chart thing that you're looking at, or if you're not looking at a large number of them week after week after week, you're making a serious mistake. And you can learn how to do this. In fact, we have some courses on chart reading if you want to go to that. But I would advise you that you've got to learn how to do that to take advantage. That's how you recognize the next big winner. Now, once you get it, you've got to have a whole set of other rules and understandings of how do I handle this right so that I don't blow it. And I think this is a good time to suggest that we all make mistakes. There's nothing wrong with that. But we like to cut them quick and fast. But the biggest mistake in my mind is if somebody bought an Apple at some point and didn't handle it right, or they bought a Microsoft at some point and they sold it for a small profit or whatever, and then the stock takes off and has a huge move, those are the ones you want to study and study very, very carefully until it's not enough to just realize I blew it, I made a mistake. You've got to write down a rule. Now, here's the key. You write a rule that if you had followed this new rule that you come up with, you would have held that stock. It would have been impossible for you to have blown it. And the reason this is important is because you're going to come up with a similar situation a year or two later, and you'll probably handle it the same way unless you come up with a rule. Chris just got through telling you he used the 8-week rule to make sure they held a stock through a sharp correction. I came up with that rule many years ago because I had botched a big opportunity, and I tried to figure out what in the world did I do wrong, and I wrote out that rule because that stock had gone up 20% in 1 week, and I wrote out the rule that if I ever have it go up out of the first 1, 2, or 3 weeks, I must hold it for at least 8 weeks. That gets me through the first sharp correction, and then I'm out way ahead because the stock is showing such unusual power. And here's the next key for this. Now you got to have a rule. What do? I'm halfway up the line. Now what do I do? And so if you don't know what you're doing and you're going by how you feel, you're going to blow it at some point. You get in some sharp correction or some news comes out. You've got to have rules that tell you you either have to get out or no, you can't sell now. You've got to hold on there.
Well, let's take a look at a stock that's not as well known as Apple, the Fresh Market, TFM. It's new to us. It's just starting to expand into the West. Some of my writers have told me it's kind of a cross between Trader Joe's and Whole Foods. What do you see about the chart? The fundamentals are pretty good, maybe not outstanding, but what are the things you like and don't like about this company?
Well, it has an A- on accumulation distribution. Now, we have a formula to determine over the last 13 weeks is the stock under accumulation or not. And I'm not going to tell you what it is because it's not a simple up-down volume of where we put the volume if it's up in price on one side and the volume if it's down in price. This is a very sophisticated thing where we're looking over the last 13 weeks and analyzing, is this stock under heavy accumulation or not? If it is, it'll be an A. If it's under some accumulation, it'll be a B. If it's kind of neutral, it'll be a C. A D is it's under some distribution, and E, this stock is being sold very heavily, and you better look into it. It is a very accurate measure. So right now, I see it has an A- that says there's accumulation that's been going on. Now, if you look at an up-down volume, it may show 0.8. Well, we find this is more accurate, but we do look at both. So that's one thing. Now, the other is the chart pattern is a long basing area, and it's starting to come out of it. It's a 44 area. It's had a run-up. It had 1, 2, 3, 4 weeks tight after the initial breakout. It ran up from there, and then it corrected for 1, 2, 3, 4 weeks. And I mentioned to you about the 10-week line, what we've learned from that. In this correction of 4 weeks, the third week it closes below the line very clearly, and the volume is less than average, okay? So you don't sell it because, gee, this stock broke below the 10-week line. It roars out of it on big volume. There was some kind of an offering, I think. The volume that shows up was an offering. But notice how the stock held 3 weeks tight right around the pullback at the 10-week line. And the volume picked up in the last week, and it's holding tight there. So this stock is also showing acceleration in some earnings. It's 19% and 27 and 33. The sales are showing acceleration. It was back 10, 12, 16, 23%. I can go on and on. What we do is we run a checklist, and our checklist would have at least 15 or 20 items that we would want to check to make sure is everything there? The estimates are good. They're increasing a little bit. You find out by how much have they beat the estimates. So there's a procedure that we go through. And, wow, look at this, 52% return on equity. That's what we like to see. We have minimum parameters. Our minimum parameter on a return on equity is we want to see at least 17%, or the pre-tax margins have to be high. However, what we're really looking for the very best stocks. We want a 50 return on equity. And that reminds me, when I bought Price Company, when they had 2 stores in San Diego, that was the Price Club that is now Costco. Incidentally, the head of Costco worked for Saul Price, and he went up to Seattle and started it, and when Saul retired, he sold his company to Costco. We made about a 15-fold move in Price Company, and they had a 50% return on equity. So what I'm trying to drive home now is it's perfect charts, institutional buying making that chart, and huge, huge fundamentals. It's the combination, and then the general market has to be right. The Price Company thing was bought coming out after a follow-through day at a market correction that went on for quite a bit of time, and we bought it exactly as it was coming out of that and had its follow-through day. So this system works cycle after cycle after cycle, but the problem is you have to do some homework. You have to learn to read charts. You have to get strict. You have to have a discipline. You don't throw in the towel because, oh, the market's not doing very well and I'm just going to cancel my subscription to the paper or take a vacation for 3 months. That's like a tennis player that's a pro saying, oh, I'm just not going to play tennis for 3 or 4 months. I'll go fishing.
And then show up at Wimbledon?
Yeah.
Okay.
Yeah, okay. So our golfer that's a pro, you lay off for 3 months and you've lost some touch. You're not knowing what's going on, and you're going to miss the next apple. So I say you have the charts, you go over them every single week, no matter what, and you learn to read these things so that you can spot the next apple, and you can do it. Anybody can do it, but you got to decide you want to do a little bit of work and you want to get real serious. Do you have something else, or we got some questions?
No, we got lots of questions. So
well,
let's answer that question. Let's go to the questions. The first question actually goes back to one of the leaderboard charts that we showed. And why don't you go back to InventSense on the daily? And the question is, do these annotations, are we putting them on after the fact or as they happen? And indeed, we put these on every day. These annotations are showing up as they're happening. So when it's a sell, we put it on that day. It's not something that we go back and put on after the fact. We're not going back, and if we make a mistake, we're not deleting the annotation. We leave the warts up there because you make mistakes in investing, and you need to learn from them, and no one's perfect. So that's definitely one thing that we do with Leaderboard. A lot of people are asking about Questcor, and that's a stock, that sold off very hard the other day on questions about its patent viability. And I guess there's a couple things. This is a stock that has been on the IBD 100, and I can tell you we did not put it on Leaderboard, and this was a conscious decision because it was a late-stage base. This latest base that it came out of was 5th stage. It's a one-product company, which is always riskier, and even though it broke out strong and looked like it was doing well, we held off because with most stocks, as you come out of 3rd, 4th, 5th stage bases, the risk of a failure becomes higher and higher. The other thing to note about that is it broke out, and in just, I guess, it was up 20% in a little under 4 weeks, so it did not trigger the 8-week hold rule. So that's another thing to know, that if you're following the rules and take your 20% profit after more than 3 weeks, that would have helped you avoid that big sell-off. I know that can be tough when things are looking good, but taking the 20% profit, we've seen that over and over of how powerful that can be because you get a gain and you look for another stock and roll that over. And the other thing that happens is, let's say back in April when the market was starting to get rocky and a lot of those stocks that had broken out, they were making 20% gains at that point. They weren't super supercharged stocks, they were acting okay. But if you start harvesting those 20% gains, you naturally start raising cash. You book profits, and you're already a little bit on the sidelines when the market starts to roll over.
Some of this has to do with psychology, too. Most people don't want to sell something on the way up while it is still advancing. So if you buy a stock at 50 and it's at 58 and 59, and when it gets to 60, you're selling it because it's up 20. And if you're cutting your losses at no more than 8%, this can work fairly well. And as you get very experienced with this, you may wind up selling and cutting your losses at 3 or 4%.
Yeah.
As you're trying to raise money to put into one that's working out better for you. So there are rules all over the place, and I think you need to know all the rules. I'd hate to be a jet pilot. I only even know half of the rules of what do I do if I have a flame out.
Well, it's like knowing how to take off but not to land.
Oh, yeah. Well, that's pretty good. I think that's what a lot of people do. They buy some stock. This is a great stock. I really like it.
Right.
Now they don't know what to do, when to sell it, or when if I got to get out of it and avoid getting into trouble.
So a follow-up question we just got on QuestCore is, so some folks who bought it at the breakout, they wrote it up and they didn't sell it, I guess, yesterday when it was crashing down. What do you do now? Well, I mean, one thing is you never let a good gain turn negative. So typically what we do is if you're up 10% and you go back to the pivot point, 10 or 15%, you want to be selling. So if you're up 20% and you're coming back to that buy point, you definitely want to sell. Again, just given where we are on the run in this stock, late stage base, the action that's going on, I wouldn't be hoping for a rebound at this point. What about you?
Well, okay, now this leads into something that's very, very important. You can't go by what you hope or what you want to see or what your opinion is. You have to go by the market, and you can't argue with the market. Now, this stock broke out. It actually ran up, I think, 33% from where a little pivot would have been, but it's broken very badly, and the volume was enormous. So you have to get out of it. And this stock could turn around and go back up, but when you see heavy volume selling and a market that's getting a little bit tricky, you can't sit there and sit and hope that it's going to go in, because you're going by how you feel. And I think you've got to have rules that say when a stock breaks in a certain way and the volume's a certain amount and you've given back a certain amount. Also, you got to make decisions. If you find you're indecisive at a point, that's one reason it's better to have rules. So I would say that if you were slow in selling, that doesn't mean you can't sell now. I don't know what the stock will do for sure, but I don't want to be holding a stock I'm losing money on. And if I'm now losing money on it, I want to cut it as quick as I can. So you need selling rules of two types. One is when I'm trying to protect myself and cut a loss as quick as I can. Don't let a 5% loss get to 10. Don't let a 10% loss get to 15 or 20. And the only way you can do that is by cutting them. And you're going to make a lot of mistakes. I make many mistakes, but they're usually small ones. I don't get myself in a position where I can get hurt badly. And then on the ones where I'm really right, I'll wind up buying a little bit more, and I'll have a larger profit. And most of my average loss is probably 3 or 4 or 5%. And I'll have a few stocks that work out very big. But I can't afford to have 15, 20, and 30% losses. And the only way you can avoid those is to cut them when you start getting into trouble. And some of them turn around and go back up. That doesn't mean that you were wrong. You're still like taking little insurance policies to protect yourself.
We've got a question about pyramiding. It's a little more of an advanced question, but when you pyramid into a stock after a follow-through day, how do you move into the stock, especially if it's moving very fast? Let's say it goes up 5% in a single day. What do you do?
Well, first of all, you're using your chart. You know that the stock is exactly at a pivot, at a buy point, because you're anticipating. You've seen this pattern's looking good, and you're seeing it, and it now hits that point. So let's say the pivot buy point is 50. And let's make it simple, and let's say you would normally, if you were going to take a full position, you would have 1,000 shares. Well, maybe you buy 500 the first time. And if that same day it goes up 2, 2.5%, 3%, I would make a second buy, but it would be a lesser amount, maybe 25 or 30%. And I don't think I would make a third buy on it, but if a few days later it gets up some more, you round out your 1,000 shares. Now, I've got to say something, though. You've got to start right. If you start late, you're making a mistake. You're chasing the stock too much. So, again, you got to learn to read charts and write down what a pivot is, what a buy point is. Put them in your computer if you want to let the computer tell you, hey, this is at a buy point, and you had 2 or 3 stocks that you had set up that way. So a lot of it is starting exactly right. If you start exactly right and you get ahead, now you can handle the stock better. But if you are late, you never seem to be able to handle them so right. But there are also some markets that are just not that good, and you shouldn't be pyramiding. You can't pyramid very much, or if you did, you'd have to cut down the amount much smaller. So you have to be a little flexible with this. I wouldn't just arbitrarily keep pyramiding everything. You better buy exactly right if you're going to pyramid.
So in a market like this, are you less likely to pyramid?
Well, I add to things, but I try to be very careful that I don't add too much. You certainly don't want to make a mistake of buying more, putting more money into it on your second buy than you did your first, or more on your third than you did. Don't fall into that trap, because you don't want your average cost going up so much.
Well, that kind of follows into this next question. When you pyramid into a stock, that raises your average cost. The question is, do you sell at 7% from your cost or the buy point? Well, you're going to be selling before you're down 7%. But
well, let's say you're selling at 7%. I would, if I bought 3 positions and I bought them correctly, the first one is exactly right, the next one is up 2 or 3%, and the next one is right. If I'm down 7 or 8% on the top one, I probably am selling that.
So
and if I'm down 7 or 8% on the second one, I'm probably selling that. So now, in some cases, I may sell the whole thing for some other reason, but I'm kind of bending with the market, and that's why it's important that you can't chase a stock. You got to start right and anticipate it, put it in your computer, and be waiting for it to get to that price. If the only time you see a stock breaking out is after it's up 5 points and you say, wow, this looks great, you're not studying your charts and you're not anticipating and you're not on top of it. It's just like playing tennis we talked about. You got to learn how to serve. You got to learn how to charge the net. There's all kinds of things. You have to learn how to hit down the line, and there's a lot to it. But you can learn it if you want to work at it, and if you're motivated enough to learn the rules and the system. We've got a lot of people that have made a lot of money, and then there's a lot of people that never made it because they never wanted to do the work.
It looks like we're getting close to our time limit, so we'll do 1 or 2 more questions, and we got a couple questions about the market. You said earlier that we were in the late stage of the recovery of our bull market. Do you anticipate one more bear market before we break out of this 12-year range to the upside, or will we just truck through highs from here?
I think it will be determined by the elections in November, and we're only a few months away from that.
Who are you going to vote for?
Well, I like people that are pro-business and not anti-business, trying to, if that gives you any clue.
Okay.
But I think that once that happens, it could happen pretty quick. It could be unusual. You could have a correction for a while. I do not believe you should have a market correction of the length that we had in the last 2, because remember, we're 12 years into this sideways thing, and the first correction was 3 years because of the wild craze that we had and just before that. And then the last one was because of the financial crisis that the government forced upon us. That lasted 18 months. I do not see an 18-month correction of the time and extent of the past one. I think it should be less than that, because actually stocks are relatively cheap and you've been adjusting, but we just got so many problems domestically here as well as things internationally that have got to be corrected. And they always get corrected. It takes time. But see, there's another thing. We don't really try to predict so much. We follow very closely every single day what the market is doing. And we know certain things that say we got to be selling and raising some cash. Then at another point, maybe 2 weeks from now or 2 months from now or 3 months from now, all of a sudden there's another point that, hey, the market has now turned. Some great problem everybody was worried about has been solved, and now the market takes off and you have a roaring bull market that starts. So we recognize the market, what it is doing at the time and place, and we adjust. So we're always in phase with it. We don't stay out of phase. So I can't tell you what the market's going to be 12 months from now, but I can tell you if it's going to be a roaring market, we're going to be right there buying the next leader.
Well, I know that's absolutely true, because a lot of times we'll sit around and we'll talk about what we think the market will do and what might happen, and many times it doesn't pan out that way, and we can be completely wrong. But when the market follows through, we're taking advantage of that. The last question is actually about follow-throughs, and the question is, how do you know it's a follow-through day as that day goes along? So if you think the market is going to follow through, it's pretty strong, it looks like it's going to close up, and things are starting to move, I guess at what part of the day are you starting to buy?
Well, in the last hour or maybe hour and a half. In other words, a follow-through day normally has to be a big day with a lot of volume and a lot of action, and it gets pretty obvious that this has been a lot more powerful than what we've seen prior to that. So, yeah, but it's a judgment that you can normally make in that last hour. And you're busy looking at charts, and there's probably something that's right at a pivot or starting to break out right then. But I think the last thing I could leave you with is don't get upset with the market and say, oh, I've lost money and I'm just not going to do this anymore. Because we have got proof in our model books that there are huge new apples of the world that come out every single time you come out of the corrections. And yet people don't know how to recognize those because they're scared and they're afraid and they're listening to the news, or maybe their broker or something. This is a skill thing. See, the research that we do is completely different than everybody else. We're not talking to companies. We're not looking for inside information. We're trying to type exactly what does a super leader look like, and we've got models of several hundred going back for more than 100 years. And the fascinating thing is that the patterns are always the same. A new product that's selling like crazy, the earnings and sales are there, and the professionals see it, and they're buying it, and the patterns form. And they're the same patterns. There's a flat base, there's a high tight flag, there's a cup with a handle, there's a double bottom. They're the same patterns that we had in 1900 and 1920 and 1950 and in 1970 and now. They're repeated over and over and over again. And if you don't believe in charts, go back and study some of these, and you'll see that every cycle they're there, and if you know how to read it, you're going to see it. Now, yes, you'll miss some, but it doesn't take more than one or two, and that could make your whole financial future. I got started with $5,000, and we got in a market, and Chrysler had a perfect cup with a handle. I bought it at 58.5. It doubled or tripled. And I sold it, and I bought Syntex, and it had a perfect high tight flag, and their earnings were up 300%, and they had a new product called the pill, which I didn't understand the total significance of it, but the earnings were there, and the pattern was there, and the volume was there, and I bought it at $100, and it went to $550. And then I had a tax problem, so we started the firm. We contributed the Syntex stock into the firm, and the firm paid the tax.
I understand.
So, and that's why we're here today.
Thank you for doing that. I really appreciate that.
I hope we've answered some questions, and I've at least made you a little curious. Get in and learn how to do this thing and get serious about it, because there will be a very big series of markets in the future, and it's not going to take too long. It'll just take a few changes in Washington, and I think it'll happen.
Well, thanks, Bill, for doing this, and hopefully we'll do more of these in the future. And I want to thank everyone who logged on with us tonight. And if you have any questions about the offers or you can't get through on the website, you can always call our customer service line. It's 800-831-2525, 800-831-2525. And once again, thank you to everyone, and we'll see you at a seminar or a trade show, but come up and say hello.
Or even a meetup club. We've got 200. We've got 200 of those across the country, and you can learn something there.
And Meetup is investors.com/meetup, and it's actually a great way to find fellow investors who are using IBD and share knowledge and really move your learning curve quicker. Thanks again, everyone.